This is Kurt Heisinger, accounting professor at Sierra College and author of Managerial Accounting. This video describes what is meant by the term cost structure and how determining the cost structure of a company can help to make accurate estimates in the future. As you see here in the first bullet point, an organization's cost structure is the proportion of fixed and variable costs to total costs. For example, if an organization has $80,000 in fixed costs, and remember, fixed costs are those costs that stay the same in total with changes in activity, and $20,000 in variable costs, those costs that change in total with changes in activity, then the cost structure is described as 80% fixed, that is 80,000 divided by a total of 100,000 in costs, and 20% variable. That's the 20,000 divided by $100,000 in total costs. One way to analyze a company's cost structure is to look at the company's operating leverage. Operating leverage, as described here in the first bullet point, is the level of fixed costs within an organization. And companies that have a high proportion of fixed costs, that is, high relative to their total costs, those companies have what's called high operating leverage. An example of that would be companies that have large investments, let's say, in facilities and equipment. I always think of manufacturing. Think of an automobile manufacturer and all of the robotic equipment that they have, along with the building, all of those large investments that they have in those items. Those types of companies have a cost structure with high fixed costs, and therefore those types of companies have high operating leverage. So the fixed cost would be the building and the robotic equipment that I just mentioned. The company might be producing 1,000 cars a month or maybe 5,000 cars a month. It doesn't matter. The cost of the facilities and equipment will be the same. So those are the fixed costs, and that would be a company that has high operating leverage. Businesses that rely on, the last bullet point here, businesses that rely on direct labor and direct materials tend to have higher variable costs and therefore lower operating leverage. Think of it this way. It might be a company that has quite a bit of direct labor and direct materials, but not huge facilities. Maybe a service company, maybe it's a landscape maintenance company, for example. And if business goes down, then that company can reduce those costs fairly quickly by cutting hours of its labor force and, of course, using less materials. And the converse of that is true as well. If business goes up, then the company can increase the labor force and increase the materials being used. So those are variable costs, and that would be a company that has relatively low operating leverage. Why is operating leverage so important? Well, it affects, first bullet point here, how sensitive profits are to changes in sales volume. For firms that have high operating leverage, they tend to profit more from increasing sales. And conversely, companies that have high operating leverage tend to have more significant losses when sales go down relative to their low operating leverage counterparts. We'll look at an example of this on the next slide. Here's an example of two companies, one that has high operating leverage and one that has low operating leverage, meaning one that has a relatively high amount of fixed costs and one that has a relatively low amount of fixed costs. Both companies have identical sales, 500,000, and both companies have identical operating profit, 100,000. But if you look at the makeup of the costs within each company, you'll notice that the high operating leverage company has $300,000 in fixed costs and $100,000 in variable costs, while the low operating leverage company has $50,000 in fixed costs, much lower, and $350,000 in variable costs, much higher. The high operating leverage company, therefore, is the one that has the higher proportion of fixed costs. Both companies have total costs of $400,000. At the very bottom of this slide, you'll notice that the break-even point differs, and this is why it's so important to understand the operating leverage of a company. You'll see that the break-even point is much different for each of these companies. Even though their sales are identical and their profits are identical at this level of sales, their break-even points are different. You'll see that for the high operating leverage company, they have a high proportion of fixed costs, so they're going to have to sell quite a bit to be able to break even. And you'll see here that the calculation here is that they've got to have sales of $375,000 to break even. I have a separate lecture that shows how to find break-even points. So this is just a quick summary. The break-even point is the total fixed costs, 300,000, divided by the contribution margin ratio, which you see up here, 80%. The low operating leverage company only needs sales of 166,667 to break even, and that's because they have such a low level of fixed costs. And that's calculated by taking $50,000 divided by, that's their total fixed cost, divided by the contribution margin ratio of 30%. So again, the high operating leverage companies tend to need a higher level of sales to break even, but once they get past that break even point and increase their sales, they'll profit much more handsomely than a low operating leverage company that is above the break even point and has an increase in sales. Stated a little different way, for every dollar in sales that high operating leverage company has when they're above the break even point, 80 cents or 80% of that dollar goes right to the bottom line, increases their profit. For every dollar in sales increase for the low operating leverage company, only 30 cents goes right to the bottom line, or 30% of that dollar. So again, low operating leverage companies tend to be less risky because they don't fluctuate as much with losses in sales, and high operating leverage companies tend to see more profit when sales go up because of that high contribution margin ratio. That's why it's so important to understand the operating leverage and more broadly the cost structure of an organization.